Are markets underpricing the risk of an Iran-related oil shock? Here's what that could mean for your portfolio and why futures may be giving a false sense of calm. Chevron's CEO warns that physical oil is tighter than headline prices suggest. That points to a disconnect between paper markets and real barrels, at a moment when traders have limited visibility into real-time flows and security conditions. When the signals are fuzzy, mispricing can spread quickly into inflation expectations, interest rates, and equity and credit valuations. The focal point is the Strait of Hormuz, one of the world's most sensitive energy corridors. Roughly a fifth of global petroleum liquids exports move through this choke point, so even small disruptions can jolt supply and push prices higher. With global demand running above 100 million barrels per day in recent years, there is little slack to absorb a prolonged interruption. In that context, a low-risk premium can be a vulnerability, not a comfort. You can already see the strain in price differentials and time spreads. When near-term physical barrels fetch a premium over futures, it signals scarcity that benchmarks may not fully capture. Add rising insurance, freight and rerouting costs, and effective supply tightens even without a formal shutdown. Limited and uneven information makes it harder for futures to reflect real-time risk, so hedges based solely on benchmarks can underperform when physical markets flare. For equities, tighter supply and higher premia can support cash flows for producers, while energy-intensive industries face margin pressure if they cannot pass through costs. Refiners may see mixed effects depending on crack spreads and feedstock access. In credit, energy issuers can gain relative support from improving cash generation, but broader high-yield and consumer-exposed credits may face spread widening if inflation stays sticky and rates stay higher for longer. In ETFs, broad market funds can feel the macro drag, while energy-focused products may benefit from stronger free cash flow and buybacks, though volatility rises with geopolitical risk. The practical takeaway: stress test portfolios for a higher and more volatile oil path. Revisit exposure to energy-intensive sectors. Confirm how your hedges behave when physical premia widen, and monitor time, spreads, and differentials, not just front-month prices. Keep an eye on inflation data and central bank signals, as an energy-driven uptick can shift the rate path and earnings assumptions. Read the full article at finlitica.com. Quick reminder: this is general information, not financial advice. Your money, your decisions, so always do your own research.